Okay, very often we hear talking about retirement opportunities, and this has been pushed a lot by the FIRE movement, that is, the idea of retiring early. But how much money do you need to retire early, actually? Well, many people suggest the 4% rule that has been created by William Bengen, a rookie financial advisor in 1994. This rule says that you can safely withdraw 4% from your portfolio of 50% bonds and 50% stocks, adjust for inflation, and live with that up until 30 years after retiring. But there is a catch. No, actually, there are several catches. Let's discuss this today. Hi guys, my name is Giuseppe and I'm a finance graduate and money nerd. And today, following many videos about the 4% rule and basing myself on this interesting paper from Morningstar, I would like to dive deep into this topic and discuss this principle a little bit better, so you can get an idea of how much money you need to retire. Also, I will try to highlight some of the flaws of this rule. Please just remember that this video is not financial advice and does not contain any financial advice. So let's get started. Firstly, what is the 4% rule? As we said in the introduction, this is a rule that was born in the 90s that assumed that it's safe to withdraw 4% from your portfolio over a period of 30 years after retirement. This 4% also need to be adjusted yearly for inflation. And the interesting point of this rule is that it is based on the worst case scenario that in the past century was retiring in October 1968, right before a bad stock market and a period of high inflation. Here we can see that with a 4% withdrawal rate over 30 years, we're allowing the 5% probability of outliving or saving in the 50-50 scenario. What are some of the strong points of this rule and what are its flaws? Well, thinking about it, there are some strong points. The first one is that, as we said, this is a rule that has been created for the worst case scenario. So if in the worst case scenario this rule still applies, it means that in the majority of the cases you should have a decent buffer. The second strong point is that there is the assumption that this rule is applied mindlessly, meaning that you're going to respect this number and spend exactly how much you're going to withdraw. So we have a second buffer that can be applied by flexibility over spending, based on the market conditions. Based on these points, there are some financial advisors that suggest that this rule can be also revised, and even the same creators suggest to move this percentage at 4.5. On the other hand, this rule faces some fallacies. The first one is that this rule is completely biased over the US stock market. Ben Felix did a great job exposing this fallacy in a video that you can find it in description. But let's try to summarize what he exposes. We evaluate the 4% rule based on historical returns over the US financial market, and these returns have been great overall. But we might be facing a case of survivorship bias, since many events that could have happened in US history simply didn't happen, and these events could have influenced the US stock returns. For example, World War II didn't damage US at all. Instead, it devastated Europe. And this created a strong advantage for the US economy. So adjusting for this bias, Ben explores some other papers that include also diversification with international stock markets, reaching a final number that is 2.7% per year. Further, another fallacy underlined by Ben is that this rule applies for 30 years timeframes. And this can be less than optimal for people retiring at the age of 65. So even worse for people retiring early, because there is a non-insignificant possibility that you're gonna outlive over 30 years after being 65. And considering also the strides of the modern medicine, we cannot actually predict in our lifetime how much your lifespan can change. Finally, another fallacy of this rule is that it applies to gross income. So you're gonna cut off the taxes out of that. That in a country like Italy, for example, is gonna be 26%. So this point needs to be considered whenever talking about the 4% rule. In the meantime, let's see how we can make the 4% rule work better, with the help of Morningstar. So Morningstar yearly publishes an interesting paper called The State of Retirement Income. I took a look at their analysis and they suggest that the 4% rule is still valid amid the increase in interest rates over the sovereign bonds. The same paper decreased this rule at 3.3% in 2021 and 3.8% in 2022. This paper also assumed that the returns of the stock are lower than the historical average, accounting for the higher prices of the stock market currently, since you know high prices are correlated with lower returns for the future. They analyze several portfolios composed of bonds and equities. The equity part is composed at 30% by US grow large stocks, 30% of US large value stocks, 20% foreign stocks, 10% US small cap value stocks, 10% US small cap growth stocks. On the bond side, 80% are US based and 20% are sovereign. Here you can see the expected returns for each asset class. We also have that the inflation is assumed to be 2.42% and all the portfolios tested at different percentage of equity have 10% of their holding in US Treasury bills, all except the ones with 100% equities. So there is an international diversification here, but I will argue that if Ben Felix is right, 80-20 is not going to be enough as a split to avoid disaster. But let's see. The first part of the paper analyzes the application of the 4% rule in different scenarios, but applied mindlessly, so without any flexibility. Here we can see the expected returns and the standard deviation for each portfolio. We can clearly see that more return is achieved to equities, but also more standard deviation. So 1000 simulations for each portfolio have been tested using the Monte Carlo simulation, and only the ones with the highest withdrawal rate with at least a 90% success rate have been picked. But this doesn't mean that they have a 10% chance of unsuccess. 90% was the cutoff, since the paper specifies that usually the success rate is much higher than 90%. They also assume the following: in case of excessing return, everything will be reinvested in the portfolio, while in case we receive less than we anticipated, we will withdraw more money and consume the capital. Another assumption is that the 4% is adjusted at 2.42% of inflation every year, meaning that if in the first year we're gonna withdraw 40,000, in the second year 40,968, in the third 41,959, and so on. And finally, the success is defined as a portfolio that has a non-negative value at the end of the 30th year, meaning that if we withdraw the last cent on the 30th year, it's a success. So under these assumptions, the studies confirm that with a 40% equity and 60% bonds, the 4% rule is still valid. And we can see also that the experiment has been extended at different portfolios and time frames up until 40 years. As we stressed, this is a very conservative case because we are withdrawing without any flexibility. And we can see that the best results are achieved between 20 and 40% of allocations in equity. On the other hand, by putting so much bonds in our portfolio, we will decrease its final value. That is not great if you wanna leave a heritage behind. They also did a simulation using historical return without accounting for the current stock valuation. And this kinda confirmed a potential rule that approximates at 4.5 over historical data. In the second part of the study, we also introduced some dynamic withdrawal measures, allowing yourself to be more aggressive during bull markets and less aggressive during bear markets. The paper offers 4 different strategies. The first one is foregoing the inflation adjustment after a loss. So basically, if we have a negative year, we do not adjust the following year for the inflation. So in this case, we can draw 40,000 in the first year, and if we enter in a bear market, we're gonna withdraw again 40,000 in the second year. This might not look so much, but the effect compounds a lot because in any case, this influences also the adjustment in the following years. Required minimum distribution, that is basically dividing the remaining value of your portfolio by the life expectancy that you have. This means that we're gonna deplete the majority of the value of the portfolio by year 30. We also need to nail the life expectancy, and we're probably not gonna leave a lot of heritage. Guardrails. So here we have an initial withdrawal percentage that we're going to adjust in case of under or over performance of the market. So if the market has a great performance and the inflation adjusted withdrawal rate is 20% lower than our initial rate, we're gonna add a 10% premium. Let's make an example. If we start with a portfolio worth 1 million and a 4% withdrawal rate, so 40,000 of withdrawal, and in the first year the value of the portfolio increased at 1.4 million, so a 40% return. In second year, we have an adjustment of inflation at $40,968. Compared to a value of 1.4 million, this is a 2.9% withdrawal rate. So we will jack this dollar amount by 10% because 2.9 is more than 25% lower than 4%. A similar mechanism intervenes if we have a bear market and the withdrawal rate is 20% higher than the initial withdrawal rate. This rule though is applied only for the 15 initial years, since bad performance in the earliest year can have the most negative effect. Finally, another strategy is based on the consideration around decreases in spending in those 30 years. So these methods consider a decrease in inflation-adjusted spending of 1.9% in the first 10 years, 1.5% in the second decade, and 1.8% in the third decade. Using these four methods, the paper investigates four different variables that are a starting safe withdrawal rate, sustainable for 30 years with a 90% probability of success, the average lifetime portfolio withdrawal rate over the 30 years period, the 30 years cash flow standard deviation, and the median ending value of the portfolio after 30 years. And these are the results over a 40% equity and 60% bond case. Out of all these factors, I want to focus on the lifetime average withdrawal rates, the cash flow standard deviation, and the final value of the portfolio. Now, if we focus on the lifetime withdrawal rate by percentage, the only portfolio that looks like a sustainable improvement, in my opinion, is the one with guardrails. Since we're just accepting more volatility in our cash flows, keeping a decent 80% of our initial portfolio value, that is still a good chunk of money to leave behind, and has a 25% improvement over the base 4% case. Now, let's dive deeper in this method and let's see the various portfolio combinations. We can increase the average life return of the portfolio by increase the equity percentage in the guardrail portfolio. But at the same time, we also increase the standard deviation of the cash flows. We can also see that different methods and portfolio combination will have completely different final median values. Now, after all these methods and numbers, what can we conclude? Well, there is no final answer at this stuff, I guess. It's interesting to see how different strategies can bring different results in terms of final value, lifetime withdrawal rates, and cash flow standard deviation. As always, there is not a one-size-fits-all approach. The study, though, is still weak to the flaws underlined by Ben Felix, since the time frame is still 30 years and the international diversification has not been achieved, at least not so well. What can we take from here? Well, there is always a trade-off between risks and returns. It's very hard to point out a precise number. I personally like and prefer the idea of the guardrail approach. It just allows you to accept some volatility in your cash flows that you can exchange for a healthier percentage of withdrawal rate. For example, in the 50-50 case, you have a 5% withdrawal rate and a final value of 80% of your initial portfolio with a 38.5% of standard deviation. In this case, we have some decent money to leave behind. We made better than the 4% rule, and it's probably a manageable standard deviation of cash flow if you have other sources of income. So in a spectrum, we can put the 2.7% of Ben Felix as the most safe case, the 4% as a base case, the 5% return in a 50-50 guardrail case, and finally the 6.2 in the case of 100% equity with the guardrail technique. If we want to be absolutely safe and allow ourselves a little bit more of flexibility, we can use the 2.7% rule from Ben Felix and adjust with the guardrail case. So since this moves from 4% to 5% in the 50-50 case, we can apply this improvement of 25% over the 2.7% case, getting 3.375%. That is not the 4% rule, but should make everyone a little bit happier or a little bit more disappointed, based on your point of view. So guys, as always, thank you for watching. I hope you liked the video, and so please leave a like and subscribe. And you might also be interested in understanding more what you can do in periods of stock market highs, and you can find it here. Bye!